If you keep all of your cash just sitting in a standard checking account, it is quietly melting away. Every single day, inflation chips away at your purchasing power, making your money worth a little bit less than it was yesterday. But there is an alternative. Instead of letting your capital erode, you can deploy it as a tool, putting those dollars to work so they generate new value for you, around the clock, without you lifting a finger. Many people avoid this because they carry a specific mental image of the stock market. They picture a stressful casino floor filled with professionals in expensive suits, shouting over each other to make a quick trade. Along with that image comes the assumption that you need a massive pile of cash, thousands of dollars, just to buy a single share of a successful, well-known company. Attempting to wait for a market crash to find a low price often results in missing the market's best-performing days, which are historically responsible for the majority of long-term gains. Because these high-growth days are impossible to predict, staying invested through every cycle is more reliable than trying to guess a perfect entry point. By planting a financial seed early on, you allow compound interest to do the heavy lifting over decades. The longer your money stays invested, the more aggressive that growth becomes. If you wait on the sidelines until you feel you know everything about how the market operates, you surrender your most valuable asset. Taking the step to set up a small, structured portfolio today outperforms waiting 5 years to start with a massive one. The very first step to establishing that portfolio is opening a brokerage account. Think of a brokerage as a specialized online bank. Instead of holding your cash to pay bills, this account serves as your direct gateway to buy and sell on the stock market. Platforms like Fidelity and Vanguard, or modern apps like Robinhood and M1 Finance, allow you to create an account in under 10 minutes. They charge 0 trade commissions, making the setup process entirely free. Once you link your standard bank and transfer your first deposit, you gain access to fractional shares. This feature solves the problem of low starting capital by breaking a single expensive share into affordable pieces. You don't need $300 to own a piece of a major tech giant or a global retailer. You can invest $10, $5, or even a single dollar to build your foundation. Historically, high share prices and transaction fees acted as a gatekeeper against small investors. Now, those systemic barriers have been replaced by software that allows any amount of capital to begin capturing growth immediately. With your account funded, you have to decide what to actually buy. If you purchase an individual stock, you are buying a tiny slice of one specific company, like Apple, Microsoft, or Johnson & Johnson. This carries a binary risk. If that single business thrives, your investment grows. But if they mismanage their products or fall behind competitors, your capital drops directly with them. To mitigate that risk, you can choose an index fund. Think of an index fund as a pre-made basket that holds pieces of hundreds of different stocks all at once. This basket automatically tracks 500 of the largest companies in the United States. Your portfolio's value is tied to the collective performance of the broad economy, which offers a layer of protection against the failure of any one business. Because they guarantee broad market participation, index funds instantly eliminate the risk of choosing the wrong individual stock. This structural safety is why they should form the core of any beginner's strategy. If you consolidate all your money into one specific sector, say putting everything into technology, you leave yourself highly vulnerable. If that specific industry faces a downturn, your entire net worth takes a direct hit. Protecting yourself from those targeted crashes requires proper asset allocation. For beginners, the most effective blueprint is the core and satellite approach. This chart shows how to structure that balance. Your core should consume exactly 80% of your portfolio. By dedicating this majority share to broad market index funds, you establish rock-solid stability across healthcare, finance, energy, and tech simultaneously. Your satellite positions make up the remaining 20%. This smaller, controlled allocation allows you to buy individual growth or dividend stocks that you personally use and trust. When selecting those specific satellite companies, you must rely on strict criteria. Look for consistent historical earnings and strong balance sheets, while actively ignoring social media trends and speculative hype. An 80-20 allocation prioritizes the steady returns of the market over the volatility of individual picks. This creates a predictable system for wealth building, where growth is driven by historical market trends rather than high-stakes speculation. Once that 80-20 structure is live, your job shifts to maintenance. Building wealth in the market is a decades-long marathon, not a sprint to a quick payday. You have to normalize the reality of risk. Stock prices will fluctuate daily, and you will inevitably see your balance temporarily drop. Market downturns are a normal, expected part of the cycle. To manage volatility, you only need to perform one primary maintenance task, a process called rebalancing. Because some investments grow faster than others, your allocations will eventually shift. Rebalancing simply means scheduling a review once or twice a year to adjust your holdings, ensuring they haven't drifted away from your original 80-20 split. By accepting short-term volatility and strictly adhering to this scheduled rebalancing, you actively protect your initial capital while mathematically maximizing your potential for compounding growth. The path to a balanced portfolio is straightforward. Open a brokerage account, fund it, anchor it with broad market index funds, and let time pass. If this guide helped clarify your first steps into the market, hit the like button and subscribe to the Finance Focus for more practical money guides. Leave a comment below letting me know what stock or fund you plan to buy first. Setting up your portfolio is just the beginning of taking control of your financial reality. Click the video on your screen right now to watch our next deep dive into mastering your personal finances. I'll see you there.